Welcome to our channel. If you want to prepare your portfolio for a potential market crash, follow this quick guide to protect your wealth and position for recovery. Step 1. Build an emergency fund with 6 out of 12 months of living expenses in a high-yield savings account to avoid selling investments during market downturns. Step 2. Diversify your portfolio across different asset classes, including stocks, bonds, real estate, and alternative investments to reduce correlation risk. Step 3. Rebalance your portfolio to align with your risk tolerance and time horizon. Younger investors can maintain higher stock allocations, while those near retirement should increase bond holdings. Step 4. Avoid panic selling during market volatility. Historical data shows markets always recover over time, and selling locks in losses permanently. Step 5. Keep some cash reserves specifically for investing opportunities. Market crashes create buying opportunities for quality assets at discounted prices. Step 6. Review your holdings and eliminate highly speculative or leveraged positions that could cause catastrophic losses during severe downturns. Step 7. Dollar cost average by continuing regular contributions during market declines. This strategy allows you to buy more shares when prices are lower. Step 8. Maintain perspective by remembering that market crashes are temporary and have historically been followed by strong recovery periods that reward patient investors. Don't forget to like this video and subscribe to our channel.